Welcome back to the Deep Dive. Today we are digging into a really high-stakes situation. We're looking at the Q3 2025 earnings call for HeartBeam Inc. The ticker is BEAT. This call happened back on November 13th, 2025, right after the market closed.
Right, and HeartBeam isn't your usual MedTech company. This is a microcap play, and they're focused on something pretty groundbreaking in cardiac diagnostics.
Which is?
They want to take the 12-lead ECG, the gold standard in hospitals, and basically synthesize it with a small wireless device, take it right into the patient's home.
So our mission today is to slice through all the corporate speak, the jargon, and get to the reality. We're going to distill the financials, the strategy, and most importantly, the massive risks that make this stock such a high-wire act.
Let's start with the numbers, because the market's initial reaction was not good.
No, it wasn't.
The stock fell about 6, maybe 7% right after the call. And when you look at the headlines, you can see why. This is a pre-revenue company.
And pre-revenue means the analyst numbers are a bit of a guess.
Yeah.
Right?
They're theoretical at best. So the consensus for revenue was around $2.6 million. They came in at 0. So that's technically a 100% miss.
Why?
And on the earnings side, the GAAP loss was negative 15 cents per share. The street was expecting a loss of 8 cents. So a huge miss there too, almost 88%.
But with a company like this, those misses are almost background noise.
Exactly. They're almost irrelevant. What really matters, what defines the story here, is cash, runway, and regulatory execution.
Agreed. And for you listening, the balance sheet is everything. It explains every single move they make. So let's get into the operating burn.
The financials really tell the story of a company just racing to hit its milestones. The net loss for the quarter, it widened a bit, up 6% year over year to $5.3 million.
And where was that capital actually going? What was driving the loss?
R&D, that was the big driver. Research and development spend was up 13% to $3.3 million. And this wasn't for marketing or sales. This was hard investment. Engineering, clinical trials, getting ready for commercial launch.
So building the product.
Exactly, building the infrastructure. They did find some savings, though. The G&A expense was down about 8% to $2.0 million. So they were being careful where they could.
Okay, that's a good data point. But it's tiny compared to the real issue, the ticking cash clock. And this is where it gets, frankly, terrifying. As of September 30th, 2025, HeartBeam had just $1.9 million in cash.
1.9 million. And you have to put that number up against their cash burn.
Which was?
Even with those savings, the quarterly operating cash burn was $3.2 million.
Wait, so they had 1.9 million in the bank and they were burning 3.2 million a quarter.
Correct. The math is brutal. It gave them less than 8 weeks of runway before they'd need more money immediately.
That is an insane margin for error.
Yeah.
So on the call, what did the CFO, Tim Cruikshank, say about this? Was he panicking?
The tone was surprisingly confident. He was very direct, though. He acknowledged the, quote, necessity for additional capital.
I would hope so.
But he framed it with confidence. He used the word optionality a lot. Optionality in their funding sources. He was basically implying that with this big regulatory win right around the corner, they could get a good deal and not dilute shareholders in a notch.
But with only 1.9 million in the bank, doesn't optionality just mean you have to take whatever deal you're offered?
That's the skeptical market view, and it's 100% valid.
It completely kills your negotiating power.
It does. The market knew that if that FDA decision was delayed by even a week or two, they'd be forced into a really, really ugly equity raise. Their whole confidence stance depended on perfect execution.
Okay, so let's pivot to that. Let's talk about the upside, the catalyst that had investors willing to stomach that insane cash risk. What was the big prize?
The entire quarter, the whole story, was built around the pending 510K clearance for their 12-lead ECG synthesis software.
And the timeline for that was supposed to be?
Management CEO Robert Eno said it was in its final review stage. He said they expected FDA clearance by year-end 2025. Imminent.
And this is so critical because they already had a clearance from back in December 2024, but this one was the real game changer. Why?
Because the 12-lead ECG is the standard of care. It's how every doctor assesses cardiac function. That first clearance was for arrhythmia assessment, which is important. But this 12-lead software validates their tech as a true clinical replacement for those big wired hospital machines.
That's what unlocks the real money.
That's what unlocks Payers, hospitals, everything.
And was the data solid, the data they submitted?
It was extremely strong. The pivotal study showed a 93.4% overall diagnostic agreement between their synthesized ECG and a standard one.
So clinically, it works.
The tech is ready for prime time. That's the proof point.
Okay, so assuming that clearance had come through, what was the plan for 2026? How are they going to launch?
It was a phased rollout starting in early 2026. Very specific target market, too. Concierge and preventive cardiology practices.
In a narrow geographic focus, right?
Right. Just two areas to start. Southern California and South Florida. The idea was to prove the business model there before going national.
And why those two spots?
A high concentration of cash pay, premium clinics. It lets them get revenue early without having to fight for insurance reimbursement right away. It's a smart way to start.
And the model itself was a subscription.
Yes, not a one-time sale. The fee would include the device plus a certain number of reads by a cardiologist. And that leads to this other key piece of their strategy, their new partnership with a company called HeartNexus.
Tell us about that. What does HeartNexus do?
HeartNexus is the service layer. They provide 247 access to U.S. board-certified cardiologists who can read the ECGs remotely. So it's a complete package. HeartBeam captures the data, HeartNexus interprets it.
A full integrated solution. And all of that, I assume, is protected by some serious intellectual property.
Oh, absolutely. This is probably their single greatest asset. Management said they got 3 new patents in Q3, bringing their total to 24.
Okay, but lots of companies have patents.
Right, but here's the external validation. They cited a PatentVest study that ranked HeartBeam number 2 globally in 12-lead ECG innovation.
Number 2.
Out of how many?
Out of 243 companies.
Okay, so for you listening, why does that ranking matter so much?
Because that's what a big company, a strategic buyer, looks for. It's not just an idea, it's a defensible world-class technology moat for a GE Healthcare or a Philips. That patent portfolio makes HeartBeam an immediate M&A target. It's the whole reason to take on the risk.
And they weren't stopping there. They were already looking at the next big indication.
That's right. After this clearance, the plan was to go after an expanded indication for myocardial infarction, for heart attack detection.
Which is a massive market.
Huge. But they were clear that would require a whole new clinical study, a new regulatory cycle.
Okay, so you have this story. High-value tech, imminent catalyst, but just fumes in the gas tank. The market was pricing in absolute perfection. Let's talk about the earthquake that happened right after the call.
Yeah.
The thing that proved the market's skepticism was right all along. Yeah, the tension here is just, it's incredible. On the November 13th call, management is forecasting clearance by the end of the year. Just 2 weeks later, November 26th, the FDA delivers a devastating blow. A not substantially equivalent letter. An NSE letter.
And an NSE.
Yeah.
That's not just the FDA asking for a bit more data, is it?
No, it's so much worse. An NSE basically means the FDA found the device to be fundamentally different from what's already on the market. It means they think it's not as safe or effective. It's a huge regulatory hurdle.
It resets the clock.
It completely resets the clock. It shattered the timeline. That early 2026 launch, gone. Indefinitely postponed.
And the stock.
Massive sell-off, as you'd expect.
Yeah.
It confirmed every fear the market had, that management's confidence didn't line up with reality, and now that tiny cash position is impossible to ignore. They have to juggle a delayed regulatory path, a commercial build-out, and a huge dilutive capital raise, all at the same time.
The path to getting revenue just got a lot longer, which means the price of staying alive just got a lot higher.
Yes, dilution is now a certainty.
Okay, let's switch gears. It's time for our This Is Not Financial Advices segment. And we have to say it.
Yeah.
We are just pitching an outrageous but plausible trade idea here. Don't try this at home.
Right. So given how binary this stock is, it could go to zero through dilution, or it could get bought out for a huge premium. We're pitching a very structured, hedged trade. The idea is to initiate a short position on the stock, but hedge it by buying deep out-of-the-money, long-dated call options.
Okay, let's break that down. The short position is basically a bet on survival, right? A bet on the dilution.
Exactly. You're shorting because that NSE letter makes a capital raise inevitable. They have to raise cash to cover that $3.2 million quarterly burn, and they'll probably have to do it at a lower valuation. You profit as the new shares push the stock price down.
But shorting a stock like this feels incredibly risky. What if that M&A thesis plays out? You could get wiped out.
And that's why the hedge is absolutely necessary. The call options are your insurance policy. They protect you from that one black swan event. What if a big player comes in tomorrow, sees the value in those 24 patents and that number 2 IP ranking, and just buys them out. The stock could go up 500% overnight.
And your short position would be destroyed.
Utterly. But those cheap, out-of-the-money call options would explode in value, protecting you from that catastrophic loss. It hedges the M&A thesis against the dilution thesis.
It's a structure that perfectly captures the conflict at the heart of this company. You've got this exciting IP, the HeartNexus partnership, but it's all being held hostage by a $1.9 million cash balance and a regulatory path that just got blown up by that NSE letter.
And it brings up a classic question in this space. How do you actually value a world-class IP portfolio when the path to actually making money from it is so uncertain and the cost of getting there is so high?
It's a fascinating test case. Valuation versus reality. We definitely encourage you to keep researching HeartBeam's next steps. Thank you for joining us for this deep dive.